Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us as we come to you each and every week, KCAA in the Inland Empire at San Bernardino and Riverside counties. We go all the way out to Palm Springs and north up to Inyo counties, as well as a little bit of LA and a little bit of Orange County, too. We have been doing this for a long, long time. They have a great signal. I want to thank the people at KCAA for bringing us to you each and every week, and for you to listen to us talk about mortgages, talk about real estate. You know, it's been kind of a down year in terms of the business itself and in terms of the actual rates that you're being charged for your mortgages. Yes, this has not been fun. We've also been hit with some real estate issues that have come up over the past, 6-7 months, but the decisions by a couple of courts, we talked about it last week, 2 or 3 guests came on, talk about how real estate commissions are going to change the way real estate is bought and sold in California. And but if you want to see that discussion or this discussion after the show's over, go to YouTube. Jeff Barton, the Mortgage Voice, is YouTube, and that's, we basically are the face of YouTube. No, I'm just kidding. But our Mortgage Voice program is one of very few that come on the air each and every week, live to you on the radio, and certainly from Mortgage Voice online at YouTube, Jeff Barton, the Mortgage Voice. You go there, you see what we do each and every week. It's not live, but it's certainly fresh, and so you can chase or chart what we do each and every week, and I think that will be something that can benefit you, because mortgage market changes all the time, and what we do and how we react to it is really what the show is all about. I'll talk about a lot of different kinds of things that will affect decision making, whether it's the world events, whether it's a weather event which might affect the way you can or can't get insurance. Some political, some other things that go on in the news, whether it's oil prices or whether it's, as I said, real estate commissions. All of these things are going to affect you and your decision about buying and selling real estate. We're trying to be the facilitator of that, and for you to make those decisions, we bring on great guests who come to the show each and every week and talk about local solutions, whether it's in the rate at a particular program, a lender that you like. All these things are really what the show is all about, and thanks very much for tuning in. Again, I'm Jeff Barton. This is the Mortgage Voice, and let's get right to it right away. The interest rates right now, what we've seen this week over the last 10 days or so, since the war in Israel, really, and since what we've seen in the Fed keeping rates the same, cooling of the economy, cooling of the labor market, and inflation also cooling a little bit more. So what does this bring us in rates? It brings us down. We were almost at 8.5% mortgage interest rates on a 30-year fixed 2 weeks ago. Today, 30-year fixed rate, 7.46. So we've come down almost a point. It's really good news. We'd like to come down another point, because that would be really good news. That would mean the affordability index would go up, and we have, I'll get to it in a bit, but we have a lot of people who's really down on the real estate market, really down on mortgages, and there's a very low percentage of people who say it's a great time to buy right now. But we'll get into that, as I said. The 6.85 is the 15-year, 6.82 is FHA, 7.82 is the jumbo rate. Now, the jumbo rates, as you know, have been on my radar for at least 8 months to a year, meaning that they're not good. And the reason they're not good is because all of these jumbo lenders got burned because of the low interest rate mortgages that they sold during the pandemic. When interest rates were at 3%, and you can go out and get a super jumbo at 3%, 3.5%, well, those particular rates, the money that was lent out, very difficult to monetize now, obviously, since we've seen rates now skyrocket up into the mid-sevens, and with the almost 8% at the jumbo here. It's a real problem for lenders who had lent out that money, who are trying to monetize it or sell or make money on that enough to be able to not only pay expenses, but to be able to refund or fund the pool of loans to be able to sell out to you in the general public. So again, that's why we see 7.82 as a jumbo, and I don't see that. I mean, we've seen it come down a little bit. We've seen it a little bit in competition with the 30-year fix. That was about 2 weeks ago, but not since. And so as we've seen the interest rates in the 30-year come down, certainly the 15-year has come down. FHA is still in the sixes, high sixes, but that jumbo rate is almost at 8% still. So nobody wants to do that at 8%. And if you have great credit, that's your loan. But if you don't have great credit or you don't have great supporting documents, it's going to be well over 8%. And that last, the 5/1 ARM is 7.19%. That's kind of in the middle. They're trying to push that program a little bit. I like the 5/1 ARMs. I like the shorter term into the ARM product if you know what you're doing. If you don't know what you're doing, stick with a fixed rate loan for 30 years. And the reason is that all of these loans can instantly go into I'm going to hurt you. Now, during the great pandemic, we saw that happen on the 10-1s, right? During 2008, 2007, 2006, anybody that got into a 10-1 ARM, what that means is it's fixed for 10 years. After that, the interest rate goes up, and it adjusts according to what current rates are. There's a cap on it on a yearly and a cap on it on the life of the loan, but it could be going from, 1% up 5-6 percentage points over the term of the 4 or 5 years that it is adjustable after the initial fixed rate period. So you really have to know if you want that loan and if you're going to get out of that loan. Now, obviously, nobody can predict real estate prices. If real estate prices, in fact, go down, you're going to have a hard time recouping that amount of money on the loan because you're not going to be able to get the same valuation. So what was 20% in one market might be 15% in another market, or 10%. I mean, it certainly happened like that in 9, 10, 11, and 12. That's 2009, 10, 11, and 12, when the real estate market really took a hit. And we saw valuations really dive. Are we in that kind of dire straits? No, we aren't. But it is something to understand when you do a 5/1 ARM or a 7/1 ARM or a 10/1 ARM, and that's why I bring it up here. As I said, the Fed rate remains unchanged, second month in a row. We may be done with rate hiking by the Fed. Now, how does this affect you? Well, it affects your credit card bill. Now, we've seen also credit card bills rise across the board in the U.S. as the money dries up from the pandemic. If the money that you had in the bank is being used to maintain the lifestyle that you want to live, that you had during COVID, we've also seen that particular, thank you. Daryl gave me the high five sign, so that's very nice. So all of these impediments that you see to getting loans that is changing the nature of the way lending is being done. So let's get into a little bit of the nitty-gritty of what is happening to the economy. And I say the nitty-gritty because it's not great news. But if you are an inflation watcher, if you are an employer, if you are somebody who wants to see home prices go down and inventory go up, you may like this report, because all of those things I just mentioned happen when, in fact, we go into a recession. Now, are we in a recession? No. Will we go into a recession? It's unknown at this point. And right now, there's a sentiment out there in the marketplace. Let's see, where is that? 85% of the survey that was produced recently say home prices are too high, mortgage rates are too high, and it's a very bad time for purchasing a home. Now, this is true. And I think the main thing about purchasing a home is they have to be available for you to be able to go out and look at it so that you can buy it. Now, new homes, one thing. Existing homes is another thing. What is drying up, has dried up the inventory over the last 5 to 6 years has been lack of building. Let's face it, if you're not building 1 million homes a year, you're behind the 8 ball. And that's where we are, not only in Southern California, but across the nation. Many markets have seen 30% increase over the past 2 or 3 years in real estate prices, simply because supply and demand. You have no supply, the demand is still there, prices are going to rise. Now, demand has been sucked out of the system. We were talking about it simply when we were talking about the Fed rate, right? What does the Fed rate do? Raises your credit card, raises your car loan, raises a number of other bills that you have to pay. And tangentially, it will also help raise the mortgage interest rates. Mortgage interest rates have to compete on the back end selling, same way that bonds are driving up the 10, 15, 10, 1 bonds in the bond market. So if debt is what you're looking at in terms of what the mortgage interest rate are, you'll notice that we have yields. That means that's the enticement to get you to buy the bonds, right? When you buy the bonds, that's supposed to be a direct correlation with the mortgage interest rate. But if they're also trying to sell mortgage-backed securities, so you have two competing things, U.S. debt at 5%, let's say what the yield is, and you have mortgage interest rate, which is driving the demand for yield on the mortgage-backed securities. So if one is better than the other, well, you're going to find the flood of money going from one to the other, and that's really what happened. But it's also really why mortgage interest rates are so high right now. You have to be able to compete with the marketplace when you're selling yield on the 10-year and on the 2-year. So mortgage interest rates themselves, if you follow the 10-year very closely, which this program has always said to do, you will notice, hey, this is what's happening. We have to be able to compete, so therefore we're spending more, and that's why mortgage interest rates are high, and what they are is scary high. Again, has come down some. Will it come down more? I'm hoping so. And I'm hoping so because the mortgage rates are really what drives interest. I mean, if you have real estate prices where they are and you don't see more houses being built on the market, you obviously need to see some give somewhere. Mortgage interest rates was the way it was. When we were seeing prices climb during the pandemic, it wasn't so bad because you had 3%. It was offset. So yes, the prices were high, but your monthly payment was lower because the interest rate was 3%. Well, now at the interest rate the way they are, you can't compete. And so what does it say? What did I say here? 85% of the survey. That means only 15% of the people think it's a good time to buy a house. That's not great. Now, there are some statistics here, too, and I want to get to in the next segment that talks about different age groups within the home buying marketplace, where they're buying, what they're buying, and, are they into buying at anything? And then we're going to talk a little about what may or may not hurt the value of your house, when and if you buy it, and what you do to it. Anyway, I'm Jeff Barton, your voice in the mortgage industry. I really appreciate you listening to the show. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. You know, The Mortgage Voice has a great website, themortgagevoice.com. If you go there, you can not only hear the show that most recently has aired, but you probably can track down those great guests that we have on the show each and every week, find out who they are, what they're doing, and how to get in touch with them. Because the products, the nature of your relationship to a loan officer, how you be able to evaluate what's out there in the marketplace are all done by these terrific people. And if you go there, themortgagevoice.com, you can find that. We're also on a number of different podcasts. Yes, we love the podcasts. Daryl, do you have a list of those for us?
I sure do, Jeff.
Thank
We're
you.
on Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io.
Okay, we mentioned YouTube earlier in the segment, and certainly we just mentioned our website. If you also want to go to a central place to get all of your podcasting needs fulfilled, whether it's alternative dispute resolution, you're in contracts all over in any kind of business, but certainly in real estate, that's all we do is we deal with contracts. And because of the new advent of broker commissions and who gets paid what, and it's just kind of a mess, you may need somebody like these people who are on this podcast on podclips.io. They're great people. They have solutions. And like I said, if you need answers to questions about how disputes get solved, they're the people to go to. Go to podclips.io and listen to these. I guess it's a couple guys, right?
Yeah, there's a couple of guys behind it, and they do a really good job. And
It's Mike and...
Mike and Mark.
Mike and Mark. Oh, excellent.
Mike and Mark, and also there's another gentleman that I've talked to recently, and he's from England, and I don't remember his first name.
Oh, okay. Well,
When it
anyway.
comes to me, I'll let you know.
Right, podclips.io. Go there. You'll have some great talk, great podcasting. Again, I'm Jeff Barton. This is The Mortgage Voice. Let's get right back to it. So we were talking a little bit about the Fed in an earlier segment, talking about how the Fed has maintained their interest rate where it is. A lot of people saying, hey, look, this could be it for raising the particular the rates. A reason being is that we are about ready to see, and see if this is true, the amount of rates that they did. I think there were 11 of them within 18 months, which is quite a bit, a quarter point, a couple times a half point. But it got us to the point where we're now, the interbank lending is at 5.25% to 5.5%. It was at a quarter point or less for 18 months to 3 years, which is, giving money away. But now, since it's like this, banks have to hold back money, which cools down the economy after a certain amount of time. It has taken a while for that to take effect. But what we've seen in the last employment report is that jobs created last month, 150,000, which is not bad, but it's way off the 300,000 the month before, which was unexpected, and really brings in line what the Fed has been trying to do, which is get a hold on runaway inflation. Runaway inflation for many people is about costs of goods and services. However, most of the inflation is in wages that are either fixed in a hourly, or they're salaried people who are fixed in that way. And so getting that under control means that the 8 to 9 million jobs that have been available every month through the pandemic, sometimes it was 11, 12 million, now it seems 8 million or so, that number is coming down, and which means that the days of, I guess, employees being able to pick and choose and say where they want to work and how much they want to get and all that kind of stuff may be closer to ending. Now, I'm not one to say that that's a good thing, but if you're somebody who's looking at inflation as your number one problem, that is a good thing. Because as soon as demand for more money ends, then businesses don't have to continue to raise prices to match the salaries they have to pay. Now, granted, costs of things have gone up, and that's true. Inflation itself has really taken a bite out of many, many different people, 17% on average over the last, 2 years, 2.5 years, is a big increase in most prices. And those, although they level off, a lot of prices haven't leveled off. Now, we're here in Southern California. Anybody in San Bernardino, Riverside counties who know driving around trying to buy gas has been expensive. And every time, this time of year, we seem to have prices lowered. One of the reasons that prices are lowering right now is because of the war, which is a terrible, awful, horrible thing. And I won't get too far into that because we're not that kind of show, or nor do we talk about that. But it has affected oil prices. We see oil for the first time in quite some time below $80 a barrel. Now, why doesn't that $80 a barrel or $79 a barrel, why doesn't that translate directly into much lower gas prices? Because in the reverse, when it goes from 79 to 89, we see instant 10 cents a gallon, 20 cents a gallon over a period of 3 to 5 days rise. Never understood it. And it's like many things that we talk about when we talk about inflation. There is true inflation, and then there's people taking advantage of that particular inflationary item under the guise of, it's inflation, we have to raise prices because. Now, because wages are beginning to come more under control. Now, when I say under control, obviously, I mean, people aren't getting as much as they want to get, even though we saw the automakers do it. We haven't seen the Screen Actors Guild get their amount, and we haven't seen the Writers Guild get their amount. But all these larger unions that you hear about so much on the news, they are about ready to get another big payday. But for the most part, your hourly average worker is, they're going to be happy with the job they have. They don't have more options to go and get another job. Therefore, the prices are more stable. Therefore, inflation comes more under control. That's a good thing, especially when you're looking at trying to squeeze into a house payment. As I said, 30-year fixed rate came down almost a point over the last 2 weeks, which is great. If you can afford 7.5% interest on a 30-year fixed, It's better than 8.5, but can you afford 7.5? Well, if the inflation numbers stay the way they are, your money will go longer, your money will be stretched longer, and you'll be able to afford that type of property a little bit more. Not a lot more, but a little bit more. Also, the restricted inventory, 3% mortgages, and the depressed market. The labor market showing unemployment at 3.9%, oil below $80 a barrel, as I said. The slowdown, the inflation drop, all these things are what's happening in the economy right now. So, as I said, if you're an inflation watcher, and this is something that is, helpful to know that inflation is better under control, that the economy is slowing. It just can't slow too much to put us into a recession, which will mean a lot of people get laid off, and that's also cyclical. We would see prices probably lower in real estate. So this is the conundrum for people wanting to buy a house. You don't want to see any kind of a recession because you might get laid off too. However, if you had a recession and your job was safe, it would be good because you would have more houses on the market and the prices would be lower. Yes, I know. That's the way it is. And anytime the mortgage rates are low, there's usually a recession as well, because what happens is the Fed cuts their short-term interest rates, and we're predicting that already. Next year we might see in the late second or early third quarter a lowering of interest rates because the interest rate raise that they did really cooled off the economy way too much. The Fed raising rates is a laggard. Now, we haven't raised rates, or the Fed hasn't raised rates in 2 months, or in 2 cycles, which is really 3.5, 4 months. So we'll see. We'll see where we are. Like I say, 11 raises in the last 18 months. That's a lot. And we'll see if that, in fact, throws us into a recession. Money is tight. Money is tight all over. Okay, a couple things. I talked a little bit about the generational age gap that we have. Millennials, where are they living? Where are some of the cheaper places for millennials, and where are some of the highest in terms of highest places where millennials are buying? Now, it's divided by city, and so I have a couple of lists here. We do these fun things with lists just because I think it's interesting to know where, certain things happen. And statistically speaking, real estate is one of those things we track very, very strongly. I mean, we know where people are buying, what's the hottest market, where rates are lowest, and where the prices are either going up or coming down. So millennials, that's that age group right below baby boomers. So a lot of millennials are in their late 40s, I guess, and so those kind of people, like 35 to 45, something like that, or 30 to 50. Isn't that what millennials are, Daryl?
I certainly think so.
Yes, I certainly think so too. Okay, so the highest level of millennial homeownership, top 5, and we'll go by state. Michigan is number 5. West Virginia is number 4. Maine is number 3. Minnesota, number 2. And the number 1 state where millennials are buying is Iowa. Now, are these called your favorite place do you want to live? Not in Southern California. We want to live here, right? So where is Southern California on this list? Are people living there or they're not?
I'd say it's pretty low because of the price.
Yes, because of the price. You're absolutely right. So here's the list of the lowest rate of millennial homeownership in the U.S. by state. Number 5 is Rhode Island. Now, I love Rhode Island. Has anybody, have you ever been there, Daryl?
Providence, yeah, it's really cool.
Oh, man, Rhode Island's a great state.
Pretty, good food, a lot of seafood.
All that. Yeah, it's just one of those places where you don't even think about because it's such a small state. You rarely, it's like Maine, it's one of these places in New England where you just, I guess they're okay, but, it's not a destination. Unless if you're a New Englander, you go to these places all the time because you know how beautiful they are. But if you're in, like, these other states where I mentioned the highest millennial homeownership, you're not thinking Maine, you're not thinking Rhode Island, but I'm thinking Rhode Island. Anyway, Rhode Island's number 5 on the lowest millennial homeownership. Nevada is number 4. It's interesting. New York, number 3, of course, home price. California is number 2, and number 1 is Hawaii. Hawaii is a very, very expensive place to live. And millennials, I guess they just don't go to the islands.
Or just live on the beach when they get there.
Yeah, well, that's what that's from the 60s. That's when we grew up.
Oh, they're still there. I checked.
That's funny. Okay, so a couple other things. As I said, there's a few things on my list about what you can do to ruin the price of your home. Ruin the price of your home. I'm going to give you the top 4. Number 4, low quality paint. Don't use low quality paint when you're painting the inside of your house or the outside. Bad tiles. Nothing worse than walking into a bathroom or a kitchen and seeing the backsplash that you just go, oh, what is that? Number 2, luxury bathroom. Don't do it. Don't spend too much. You never get your money out. And number 1 is too much wallpaper. I don't know what that means. My house has none. But maybe yours is like Grandma's place. Lots of wallpaper. Don't do it. Lowers the price of your home. Anyway, I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us, listening to me for year after year, week after week, and certainly this week. We've seen the Fed do what they do, which is really hold interest rates where they are. It seemed to have sparked some lowering in interest rates for your mortgages, even though it's not great. It's better than it was. It's 7.5% for a 30-year fixed. Also, if you want to see and hear this show each and every week, and you can't make the radio at kcaa.com on Saturday and Sunday, go to YouTube. Jeff Barton, the Mortgage Voice, is our show. And if you go there, you can not only see this week's show, but the archived decades worth of shows that are on there. We have many, many, many great guests that come on and explain not only programs, but how they work with individuals and how they bring to you the best quality loan products out there in the marketplace. One of the people that does that joins us once again. He's one of our favorites on the show, and we really thank him very much for coming again, is Charles Giscombe from USF out of Utah. Charles, how are you?
I'm doing great, Jeff. Thanks for having me, as always.
Thank you very much for coming on the air. Okay, so we've seen a little bit of a reprieve on rates, which is a good thing. One of the problems with that, of course, is we don't see a corresponding increase in the number of properties available in the marketplace. Shaking this market to whatever is going to come next, where do you see it, and what kind of products are popular in this particular week?
Great question. Great bunch of questions.
Yep.
You know what, Jeff? The Feds did what they needed to do. The interest rates came down a little bit. And so, people are, it's so funny. People are excited about that. There's some movement.
Right.
But we're used to that. We're used to the up and down movement. But one thing Jeff said was super important is the amount of properties available. That hasn't changed.
Right.
The Fed doesn't control that. So at this particular point in time, we're still transacting. As the rates come down, a lot of the properties were available because the rates were high. People are afraid to move. They move down a little bit. You might get some more interest, but the properties that are available are still the same. What I say in those situations always is those people that are sitting on the sidelines because of the interest rate, there are other programs out there that will allow individuals to get in the game, to transact, offset the higher interest rates, and still get in and have a decent monthly payment and be able to take care of this market. You'd be so surprised at how these interest rates that have happened over the last 6 months have sidelined so many people because they've been spoiled by the lower interest rates that we had in previous years. Now, if you're not afraid, if you have a loan officer and a team and you have a strategy on an understanding of how this market will correct itself and change, we'll not get back to the all-time lows, but still we'll get back to a favorable interest rate. You should transact now, because now what you have is a loan that you're not going to keep, but still it'll allow you to take advantage of all these other people that have stayed on the sideline because they're interest rate conscious. And that's non-QM loans are the big thing that we've been working with, Jeff.
Okay. No, I know that non-QM loans have been popular and are popular with a group that is, currently in the marketplace because they're not your standard 30-year fixed. They're not your FHA type loan. There are other loans that you can do, obviously, with less paperwork, with a credit score that may not be as important. Maybe a down payment can substitute for a credit score in a certain range. All of these things are good alternative programs. I often think about the stock market, and because I watch a lot of business channels, whether it's Bloomberg or there's CNBC or any number, MSNBC, any number of these different types of programs, and they're always on there pitching what to buy. They never tell you, hey, this is a terrible time to buy, because it's in their best interest in the people that they serve to be able to continue to pitch. In our business, we are subject to the rates that come down from the mortgage, usually the 10-year mortgage-backed securities as well. Where do you see the market? And a wrap-up here is, we as professionals, how do we deliver the message? What's the best message to deliver? And is there a time where we say, you know what, maybe you should just sit on the sideline?
Jeff, it's really a difficult time, and it's a difficult conversation to have.
Yep.
Because if you're a mortgage professional, like we have been doing this for a very long time, Jeff and I collectively may have 60 years experience on the phone.
Yep.
At the end of the day, when you have that much experience, you understand the trends. We've seen this come and go so many times. So talking to someone who has fear of jumping in right now because of the interest rates, well, we don't have the fear because we understand the market trend. But somebody else getting in brand new may be concerned. And they also are looking at TV and listening to their peers in regards to what's happening in the market.
Yep.
Everybody has an idea of what's going to occur, and a lot of people are getting scared out of the game. The thought process I have is, be thinking short term. Do not think long term. Short term will allow you to get in the game, get aggressive, and have the acquisition, while you strategize for long term so that we know we'll refinance into a lower interest rate. Lower interest rates will come. Whether they come in 18 months, 24 months, 36 months, the interest rates will come. So what we need to understand is that when we're telling these individuals, and I'm having my discussions, I'm explaining to them, we have to get a 1 year, 2 year, 3 year, 5 year plan in regards to what we're doing. And that way, when the market does move, we're not panicked. We understand that we're in loans that don't have prepayment penalties. And if they do have prepayment penalties, they're short prepayment penalties and will allow us to transact within 12 months right away when the market does change. I think that in our discussions with our clients, if we can explain that, and more importantly, our expertise allows us to stay calm, the more we can allow them and give them the comfort to feel calm so that we can move forward with a strategy and a plan that meets the need today and tomorrow, Jeff.
When doing these types of loans, I always get a little bit nervous because this is the type of market where you're seeing all kinds of different documentation, either on income or on employment or on credit. All of these things are, the basis by which loans are given. In products that don't concentrate on that have either a down payment or a DSCR, do you see that as more of an answer in a market that you may see more documentation that's creative?
Yeah, you know what? The DSCR loans are becoming favorable. I'm even seeing DSCR loans lower the debt servicing ratio now. I even see them lower it now to get people in, okay, to get these kind of loans, because they're understanding that, there's a different trend and a different twist that allows you not to have as much paperwork also with that loan. Usually in most cases, if the monthly, if the income, over the expense, if you can meet that need at a certain factor or ratio, then you automatically can get into a loan. And sometimes that counteracts credit score and different documentation. I'm seeing a lot more loans like that, and they're easier to get done because now it's more reliant on the income and paying that expense monthly than it is on that person's personal credit profile, financial profile. So I am seeing a lot of that more so.
Credit score. Let's talk about that for a second. What do you see as the average credit score? Has it remained the same, or as money gets tight? Now we've seen nationally credit cards themselves have really gone up in terms of the amount of balances on them. Do we see that correspondingly hurting credit scores at all?
Well, what happens with credit scores is that, when you're using so the banks want to see when we're looking at clients, are you living off your credit card or just using it for convenience? If you're using it for convenience and you're keeping it at a certain level, 30% or below 20% of the actual credit limit or balance, that's great. It actually helps your credit. If you see people with higher credit, utilizing their credit, it means a lot of times banks look at that as you're living off your credit.
Right.
That'll take your debt to income ratio up higher, and then and in that space lower your credit score. So what we look for is we have products all over the place. We can go from a 550, 560. That's where you can get into the game at with certain type of scores. And obviously the premium and diamond programs are unleashed at 700, 720, and they've even moved up some, 720 to 740. So, if you're looking for the best interest rate, if there is a best interest rate out there, obviously you're looking for a higher credit score. What I tell people is, in this market, you're not keeping that interest rate. So if you have the ability to qualify and get in with the 650, 660, get in the game, because you're not going to keep that. Even a person with a 780 credit score is not keeping the interest rate that they have right now. They're going to change it as well. They're going to refinance it down into a lower. So if you have a credit score that allows you to get in, do the best you can to keep your debt to income ratio down. All that is your monthly liabilities along with the new house payment. And if that's 50% or below your income, that's the keep it simple, stupid rule of qualifying.
Hey, let's talk about credit scores just for a second. Let's incentivize people to get a better credit score. Give me an idea of the difference between the rate if you have a 740 FICO score versus, let's say, a 640 FICO score.
Depending on what kind of loan you're doing, obviously, Jeff, that can be the difference between, at a 740, a 6.875, or a 7%, 7.5%. The difference in that can be a whole 1.5 or 2 points.
Right.
You can go up almost 2 percentage points on your interest rate, the difference between a diamond 740 and a 640. You can still transact. Like I said, I tell people all the time, your credit score, yes, it unlocks the opportunity and the ability for you to get higher loan-to-value loans, higher loan amounts, and also better interest rates. But you still can transact with a 640. And if you have a mortgage professional that understands credit, they can run what-if simulators and let you know what you can do and what you need to pay down to the dollar as a strategy to get your credit scores up to the 740s if you need so. There's different tools and resources that we have in play that your mortgage professional should be able to introduce to you that will give you some strategy in order for you to get that higher credit score. All right? So you still can transact down to a 620 even. But there is a difference in the interest rate, and in some cases with non-QM loans, Jeff, if you don't have a 720, you can't get the 90% LTV. You could get the 85%, but if down payment is super important to you, it's always great that you max your credit out as far as score is concerned, so that you can open up the programs that allow you the better terms and the better rate.
Excellent. Great information. Listen, we're about up on our time. Let people know how they might be able to get in touch with you and all these terrific products you're talking about.
Absolutely. Thank you so much, Jeff. You can always reach me at 702-328-5191, that good old Las Vegas 702-328-5191, or you can reach me at Giscombe at usfwholesale.net.
Excellent. Thank you very much, Charles. Thanks for coming on the show. Always like it. Great information.
Thank you so much, Jeff.
Okay, we'll talk to you later. I'm Jeff Barton, your voice in the mortgage industry. That was Charles Giscombe from USF, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to what we have to say about what's going on in the mortgage industry. And there is a lot always going on in the mortgage industry. It's up, it's down, and currently it's kind of a little bit sideways. We've seen the rates retract a little bit from their highs of about 8.5% down to mid to low 7%. It's good, but it's not great. Housing inventory is not great. If you want to see, hear, and know what we're doing and how we're doing it, go to YouTube, Jeff Barton, The Mortgage Voice. Go to my website, which is themortgagevoice.com. The KCAA website will definitely have many different ways by which not only can listen, but also see what we do on a weekly basis. We're on that radio station in San Bernardino and Riverside counties every Saturday and Sunday, and that's a great thing. We have some podcasting as well. Daryl?
Yes, we do. We're on Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, radio.com, YouTube, and podclips.io, and, of course, themortgagevoice.com.
Okay, so now that you've got a place and a time by which you can not only see and hear us, just check us in. Click on the button. Hit the bell. Whatever it is you have to do to join what we're doing. Get in the conversation. I get a lot of people that have done so over the years. Our audience is continually growing, but as the mortgage rates go up and down, so does our audience. So when times are good, we get a big following. When times are bad, we just try to educate and inform, and a lot of people obviously are looking for answers. With that, I bring you Connie Hernandez, who's been with us so often. She's like one of the founders of the show now, and I really appreciate not only her expertise, but the fact that she's been an originator and been in this business for a long, long time. She works for PMA. Connie, how are you? This is Jeff again. Nice to talk with you.
Doing great, Jeff. How are you?
I'm fine, thank you. Sometimes you get lost in these intros and you have no idea where you are, but you keep talking, so apologize about that.
No, great information. Always happy to hear what's going on.
Yeah, me too. And so let's get right to it. Yeah, you're over in West Covina in the Los Angeles area, certainly servicing San Bernardino and Riverside. What are you seeing in the real estate world affecting both the mortgages you can offer and some of the programs you might be able to offer?
I think the challenging part right now in real estate is the lack of inventory. I'm sure you've heard this many times already. And, there's still competition for the little real estate that's out there available right now. But there is definitely a sense of lack of inventory in the San Gabriel area.
Yep.
Riverside area is actually not too busy either. So I'm hoping that has a bit of a change in the near future. I'm not really sure that I believe that interest rates were to move in our favor or drop, whether more inventory would be available or more people would be encouraged that they have thinking about selling if they go and sell now. I'm a little disappointed because, truthfully, the prices of homes have not dropped the way I think a lot of people thought they were.
Me too. Yep.
So I thought, if anyone wants to take advantage of the peak, because we are definitely in a peak, they would do so. So we would have an abundance of real estate. But I think more than anything, possibly discouraging where people maybe submit offers and then they try to get their loan completely financed. And it's been challenges that have gone to a point where, it's just become a little bit more difficult. I've noticed in some of the guidelines with Fannie Freddie that things have gotten a little tougher. For example, I had a challenge with one loan where we were doing an 80-20, unbeknownst to me and, my fault, but at the same time, something brand new that my client was buying another primary residence. She had already rented her home. So she had tenants in her primary home.
Yep.
She moved in with her parents to make sure she would, she had her tenant in place. She thought she was doing the right thing. But now with a second, unless you have a housing expense, you can't qualify for a second. She had no housing expense because she had moved in with her parents temporarily until her loan closed. Mind you, we took it up the ladder because that guideline was meant for more than anything mortgage shock. Yep. And my client, psychiatrist, made very good income, great credit, and unfortunately they did not budge. And I tried several different second TD lenders that would take a second position for a purchase loan, and I got the same results. No housing expense, they cannot do the loan. So that was kind of heartbreaking. We had to go back to a 90% loan, which she didn't want MI, but we were kind of forced to go into that. She qualified. Again, not happy about paying MI, but, these are the things that we're facing right now.
So you have to wait, 6 months and then refi them out of that so they don't have the PMI?
Depending on the value of the properties.
I see.
That if it goes up, she was very fortunate because her realtor did a great job, got her into a property where the value actually came in about $20,000 higher than what she paid for the property. So that was a plus for her. But, again, there's constant changes in our guidelines that we have to be aware of. But, our job is to find solutions. I think you and I have had this conversation many times. Our job is to find solutions.
Yeah, I agree with that. And I do also agree that lending standards have really tightened. And I think there's a great fear among a lot of lenders. I think it's a hangover from 2008 that this whole cycle is going to revert into some implosion somewhere, which makes loans not as valuable as they were. And a lot of these lenders are very, very afraid of that. And I think that's one of the reasons that you see interest rates where they are.
I believe you're absolutely right, Jeff.
Right.
But, the encouraging, on a good note, I was able to participate in mini seminar with an SBA lender, which was encouraging because even though we primarily do residential, we also dabble a little in commercial.
Right.
And this particular lender, I'm not saying all lenders, but there are some lenders out there that are looking for solutions because obviously their pipelines are not as healthy as they used to
right,
be.
So, of course.
In this case, this particular lender was offering some really amazing programs for SBA loans. And these are for business owners, whether they're real estate related or the business side of the SBA loan. But really encouraging. They're flexible. They're willing to look at the deals. They're willing to think out of the box. There seems to be a little bit of money available right now for business owners as far as cash flow, things of that nature. So, like in every situation in the industry, sometimes we have to learn to pivot a little bit until things change, right?
Yes, and I agree with that. I want to get, speaking of pivoting, there is, I got a notice from the California Association of Realtors. And as you well know, there is a commission lawsuit that has been lost by not only NAR, but a number of other large real estate firms in different states, not yet in California, but have really rocked the boat in terms of what's going to happen. So this notice from California Association of Realtors, like it's all okay, don't worry about it, it's all terrific. What's your take on real estate commission lawsuit basically saying, hey, look, you as NAR have been conspiring with these local real estate firms to keep commissions too high by making the seller pay for commissions for the buyer's agent. And if that, in fact, is going to go away, which I absolutely think is, regardless of the appeal, because it just logically seems to be that's where it's been heading. A number of these large lawsuits have happened, $5-6 billion worth. What's your take on all that?
I think it's a sad day because the thing is that there is a lot of effort, time, money, with no guarantee of pay that most agents that are representing buyers incur. And at the end of the day, myself, as a seller of a property, I understand that to sell my property, I am going to have costs. And with that being said, this has been in place for many, many years, even before I've come on board, which has been 30. Mm-hmm. So I don't understand the logic. I just feel that, with technology the way it is right now, and with AI just kind of creeping in closely behind what we're aware of, as far as our industry goes, these are changes where, it's always about eliminating jobs, right?
Yep.
And unfortunately, it would be I think it would be a disadvantage to our clients, both the seller and the buyers, to not have the choice of being represented by a different party. Because at that point, you have to think of our fiduciary relationship to the seller as the listing agent. So what happens there?
I agree, but you all know that
there's just so many things that I'm baffled with.
Right.
I don't agree with it. I feel again, there's a lot of things they're not taking into consideration. But then you have to wonder, who's coming up with these ideas and why?
Well, however it happens, the seller is not going to want to pay if they don't have to, and the buyer is certainly not going to want to pay because they never have. So it's going to mean that the squeeze on the buyer's agent is going to be immense. and whether they come up with a flat fee or some kind of diminished pay, I don't know how the buyer's agent is going to survive. That's my contention, and that's only going to hurt the market because the buyer is then underrepresented.
Exactly. The buyers, exactly what you said. There's more buyers that are going to be underrepresented.
Right.
And again, I don't know, who is coming up with these ideas and why they feel they're good ideas. I don't believe they are. I think in the long run, we're going to have a lot of other issues that they're not thinking about, because if you only have one side, but you have two parties, there's a lack of representation on one side, right?
Of course. I mean, that's the problem. And then it's going to land on the listing agent to represent both sides. And they're going to have to take a huge haircut because they're not going to be able to get 5%. No, they're going to say, no, you're going to do it for 3%, 2%, both sides. That's what's going to happen.
But the liability,
the what?
That's the liability on the agent.
Oh, of course. That's what I mean. So this is all just going to lead to poorer service, poorer representation, and buyers getting it in the shorts. That's my opinion. Listen, we're going to talk about this some more. We're up against it right now. Could you let people know how they can get in touch with not only a great loan officer, but also a broker that's been in the business for a long time and can help? No, you have. You know a lot of stuff. So shout out how you can get in touch with you.
Thank you, Jeff.
Sure.
You can reach me at 626-422-2017 is my direct line. My office line is 626-918-2419. We're on the corner of Badillo and Citrus in downtown Covina, 101 North Citrus Avenue. Like always, Jeff, it's always a pleasure.
Oh, always love talking to you, Connie. Thanks very much for coming on. Really appreciate it.
Thank you, Jeff.
And thank you. That's Connie Hernandez from PMA. I'm Jeff Barton, your voice in the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.